Welcome to our video on financial cushion. Today we're going to look at what it is, why it's important, and how to create one. A financial cushion or emergency reserve is an important component of your financial plan that is designed to ensure financial stability and protect against unforeseen circumstances. Here are some key aspects of a financial cushion. Protection against unforeseen circumstances. A financial cushion helps you cope with unexpected events such as job loss, medical expenses, accidents, repairs, etc. It provides a financial buffer so that you don't run out of money in such situations. Stress relief. With a financial cushion, you reduce financial stress and improve your psychological and physical resilience in uncertain times. Choice of storage tools. A financial cushion can be kept in accounts with high liquidity, such as a regular bank account, or invested in less liquid but profitable instruments such as deposits, bonds, or investment funds. Store the financial cushion. If you have used up part of your financial cushion due to an accident or other circumstances, it is important to plan to rebuild it until it reaches your target size. Investment approaches. You can also consider investments for a portion of your financial cushion to provide a higher income. However, be careful and choose investment instruments that match your risk level. But what should be the size of the financial cushion? The size of your financial cushion can vary depending on your individual situation and needs. The basic recommended size of a financial cushion is 3 to 6 months of living expenses. However, you should consider the following factors when determining the size of your financial cushion. Income. If you have a stable income, a minimum of 3 months of expenses may be sufficient. If your income is unstable, for example, if you are a freelancer or entrepreneur, you may need more. Marital status. If you have a family or children, you might want a bigger financial cushion as you will need to be provided for in case of unforeseen circumstances. Job. The type of job you have and the degree of stability can affect the size of your financial cushion. If your job is less stable or you are at high risk of losing your job, you may need a larger financial cushion. Pension security. If you have retirement savings or other sources of income after retirement, this can also affect the size of your financial cushion. Living expenses. The size of your financial cushion should take into account your monthly expenses, including housing, food, medical care, transportation, insurance, and other basic expenses. The best way to determine the size of your financial cushion is to consult with a financial advisor, who will take into account your unique situation and goals. A general recommendation is to start by building a financial cushion that covers at least 3 to 6 months of living expenses, and then consider increasing this reserve in the future. To determine a specific amount, try to consider your current financial obligations and risks. If you have a family or a mortgage to pay, you may need a larger financial cushion. You can follow these steps to determine the size of your financial cushion. Estimate your expenses. The first thing you need to do is calculate your monthly expenses. Include the costs of housing, food, transportation, medical care, utilities, and other mandatory expenses. Consider the risks. Consider unforeseen circumstances such as job loss, medical emergencies, or accidents. Consider what risks could affect your finances and factor them into your financial cushion. Create a plan. After determining your target nest egg, develop a plan to build it up. Regular contributions to this reserve will help you achieve your goal. Monitor and update. Periodically review your nest egg and update its size as your life situation and goals change. Even if you don't build up a financial cushion, you can now see if there are any unnecessary expenses among your expenses, so you can cut them. In fact, there are not many options because money does not appear out of thin air. To start making some savings, you'll either have to cut expenses or earn more by looking for additional sources of income. Financial experts advise living by the 50-30-20 principle whenever possible. 50 of earnings should be spent on permanent and mandatory needs. 30 can be spent on irregular purchases or optional expenses. 20 should be saved. Of course, not everyone can afford to save 1/5 of their income on a regular basis. But this is not a reason to give up saving altogether. Even 5/10 of your salary is better than nothing, especially if you put it at interest or somehow protect it from inflation. To succeed, you need to follow the main principle. Building a financial safety cushion should be a priority expense along with paying your obligations and utility bills. Try to do this first of all immediately after receiving a salary or other income. A lot of people, when they are going to build up savings, expect to put aside the amount that remains in the budget at the end of the month. However, as a rule, by this time there is no money left at all, and the start of creating financial savings is postponed to the next month, and so on and so forth. Usually, these are the type of people who like to start a new life on Monday, quit smoking and drinking next month, start playing sports in the new year, and so on. If your salary comes to your card, you can set up automatic withdrawals. Most banks provide an online banking service where you can set up a monthly transfer of a certain amount to a financial cushion account. The main idea is that you shouldn't expect instant results. Yes, you are unlikely to find that you have become significantly richer in just a couple of months after you started saving. But when you really need the money, which may happen in 5 years, you will be grateful to yourself that you have accumulated a solid amount for such an eventuality. Maintaining a financial cushion is an important step towards financial stability. Carefully plan where to save this money and keep it in a special account or investment with easy access. To maintain a financial cushion, here are some useful tips. Create a monthly budget in which you define your income and expenses. Regularly track what you spend your money on and try to reduce unnecessary expenses. Set up automatic transfers to your financial cushion so that you always set aside a portion of your income. If possible, when you receive bonuses, gifts, or extra income, try to put it aside instead of spending all of it. This can build your financial cushion faster. Make a plan for unforeseen circumstances, such as accidents or medical emergencies. Have money set aside in a trust account or financial cushion for such situations. Consider investing some of your money to generate higher returns. However, be careful with your investments and don't risk your financial cushion. Review your financial cushion regularly and make sure it meets your current needs and goals. What if I can't save? If you are unable to build up a financial cushion, it is most likely due to one of the following factors: not taking savings seriously. You need to save regularly, and you should take from the reserve fund only in case of unforeseen circumstances. Without this, nothing will work. Unnecessary expenses. Financial literacy and budgeting will help you get rid of them. This way, you can optimize your expenses. Insufficient profit. Unfortunately, it happens. The best way out of such a situation is to look for ways to increase earnings. With a financial cushion, you'll be prepared for life's emergencies. Ensure your financial stability. Create and maintain your financial cushion today. You can learn more about financial management and building a financial cushion on our channel.